The reason that we invest is to keep up with, try to beat, but at least slow down inflation in some way, or at least the effects on our money. Yes, inflation is going to keep happening, and in my opinion, it's going to keep happening at a much higher rate than it's happened before, which means that investing is worth that much more. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Now, this is a segment that I call office hours, which is just like when my students come after class and we talk about something more in depth that we went over in the lecture. And usually I take a question from one of you or maybe two of you down in the comment section down below. So if you do have a question or something that you want me to go over, go ahead and throw that down in the comments. But for today, I don't have an actual question from any one of you, but I do have something that I keep seeing in either my comment section or in other people's comment sections, and it's kind of just things that people are thinking about in the wrong way, and it's usually very detrimental. It's either hurting them or it's hurting other people when they read what it is that people have to say. And so I want to talk through a couple of those. So the first one on this list has to do with dividends. And now dividends are just awesome because you invest a certain amount of money in the company and they give you a little portion or a little percentage every quarter. And obviously, who doesn't want that? So sometimes on my channel, I'll do something with like an example and I'll say something like, okay, if a company has 5% dividend yield and you invest $100,000, you'll have $5,000 in dividends. So every quarter you'd get $1,250. And there's two types of negative comments that I get from this. And so the first one is,
yeah, but you're gonna have to pay taxes on that.
Okay, true, kind of. But let's talk about that. If your boss came to you and said, I'm gonna give you a $20,000 raise, would you be happy about that? Or would you be thinking about the taxes that you're gonna have to pay because you just got that raise? At the end of the day, you're making money. Yes, you're gonna have to pay taxes, but that's a small portion compared to the profit, the actual cash, the money that you're gonna be able to have that you didn't have before. And let's talk about those actual taxes. Because at your W-2 at your work, if you were to actually go up $20,000, you'd have to pay $5,000 or so of that. Anywhere between 20 and 30% of that would go straight to taxes. With dividends, there's a possibility that you could pay 0% in taxes, but most people will pay something like 15%. So if you were to get $1,000 worth of dividends and you had to pay 15%, you would have $850 that's yours that you didn't have before. Now let's talk about that 0% possibility. If you were living off of just dividends, just passive income, and you made $40,000 worth of dividends in that year, and that's your only income, you would have to pay 0 in taxes. You only have to start paying taxes after about $41,000. And if you're married, it's after $83,000. So thinking about it like that, if you have a household income right now of about $100,000 to $120,000 as a married couple, with your W-2, you're actually living off of probably closer to $80,000. With dividends, you could get up to $83,000 as a married couple and not pay any taxes whatsoever on that. And so that's the exact same amount as if you were making $120,000 from your job. That's a crazy hack. And the next comment that I get from these dividend haters, or whatever you want to call them, is that return isn't worth the investment. So let's talk about it again. Let's say you have a 5% dividend yield and you invest $100,000. You're putting your $100,000 into this company, and for that you receive assets in the form of stock. You're also receiving that quarterly dividend, and yearly you're going to get around $5,000. So a lot of times I'll see comments like,
well, it's going to take you 20 years just to break even.
That is one way to look at it, but honestly, it's not the right way to look at it, because that money is there at any time if you want to take it out. So let's say 2 years in, let's say you had that $100,000 in there. The first year you made $5,000 off of dividends. Still have $100,000 in there. The next year comes, you make $5,000 off of dividends. That $100,000 is still there and you've made $10,000. If you want to, at the end of that second year or third year, pull out all of your money, technically now you have $110,000 in total from that investment. It's not like you're using the dividend to pay back this investment because it's down and sunk. It's there. Now, yes, the company could lose value over time and then, yeah, you are losing that money, And that is the risk in investing in general. But it's different than, say, paying for something, like buying a tractor or something, and that tractor is $50,000, and it's supposed to bring you in $5,000 per year. Yes, to pay that back, it's going to take 10 years of that $5,000 profit to pay back that initial investment. And then you're really only profiting once you get past that break even. With dividends, with stocks, it's much different because there's an asset that you actually own, and at any time you can sell that asset back to get your money back. And hopefully the asset will have appreciated or at least stayed even, especially if it's a dividend stock. If it does go down, yes, you will lose some money, just know that. But overall, I want you to be thinking about dividends as much different than just paying back or getting back to that break even. One last thing to hit this point is, yes, I understand that $100,000 put into the market means that you can't use that $100,000 for something else, so the opportunity cost. And yes, you'll probably get a better return putting that $100,000 into real estate and making cash flow with price appreciation or something else, maybe even starting a business. But the thing is, dividends is the most passive way to actually make that money. We're talking about if you want something that's going to grow that amount of money more, you're going to have to think of active ways. Starting a business, you can't just sit back. You're going to be working every day with that. To each their own, but I just want you to know what the difference is. The next comment that I get and I keep seeing is one where I'll have a video where I say, you invest $200 a month for the next 30 years or something, comes out to $1 million. Awesome. The comment that I get though is,
well, $1 million in 30 years isn't going to be worth anything.
So what they're saying is $1 million isn't going to be enough at that point, or that it's not even worth it to have $1 million because inflation's going to be so crazy. And to that, I always respond with, would you rather have $1 million or not have $1 million? Because especially if that's true, especially if $1 million is something like $200,000 in today's money or something like that. If you have zero at that point, you're in way worse shape than somebody who does have $1 million, even if that $1 million is worth much, much less. The reason that we invest is to keep up with, try to beat, but at least slow down inflation in some way, or at least the effects on our money. Yes, inflation is going to keep happening, and in my opinion, it's going to keep happening at a much higher rate than it's happened before, which means that investing is worth that much more. We want to use compound interest. We want to use anything available to make our money work harder for us while inflation is trying to take that money from us. So while I see what you're saying and saying that, $1 million might not be worth as much as it is today, probably agree with that. What I don't want people to do is see that and then get discouraged from investing. Or if that's your thinking, and I hope that doesn't discourage you from investing, it should encourage you to get as much invested as possible to keep that thing working and hopefully have more than $1 million. And the last comment that I want to talk about today is one that I get a lot and I do agree with, but I want to make sure that we are all on the same page here as well. And this one's along the lines of
past performance doesn't equal future performance.
And I totally agree with that. Just because something happened in the past doesn't mean, it's 100% going to happen in the future. But why do we teach history in school? It's so that we can look back and see what happened then and make an educated prediction and be able to do something now so that something does happen in the future, maybe better than it happened before, or at least understand and predict based off of some data from before. Other than that, what else can we predict on? What else can we do other than say, well, AI seems to be hot. Maybe things with AI technology should go up and increase in value later on, but we don't know how much, we don't know why. We can just kind of guess. For me, when I look at something like the S&P 500, and statistically it's brought a 10% annual appreciation since 1957. What that does for me is it doesn't tell me, okay, it's had 10% yearly appreciation and so I can expect 10% forever. What it does let me do though is it lets me see, okay, this is a lot of data. This is a long period of time. What's happened in that amount of time? Have we had recessions? Have we had great recessions? Have we had crazy economic collapses and different things like that? And what did the market do then? And what did it do after that? And so now I can see, okay, the market responds in this way, and specifically this fund responds in this way. And so then I can make a pretty solid educational prediction that It's going to continue to do that because I've seen it weather the storms up until this point. Now, yes, 100%, something crazy could happen, something absolutely catastrophic to where the whole stock market just implodes. If that happens, I'm not really too worried about money. I think that we should all be worried about a monster world war or something crazy. But literally other than that, I can pretty much count on the fact and the data of what I've seen for this long in a certain fund. That's why when I look at ETFs or index funds, I try to see how long the history is and what's actually happened within that. I don't tend to put money into anything that's been around for less than 10 years because I want to at least see what's happened in that amount of time. But I would much rather be in some type of fund that's been around for much longer, even if the return is lower than some of these newer ones, because I'm more about sustainability long term, and I want to make sure my money's there when I need it 20 years from now. And now if you agree or disagree, I would love to hear from you down in the comments section. And again, I'm looking for those questions or topics that I can talk about in the next office hours. Have a good day. Professor G, out.